If I told you stock prices flashing daily are least important in investing, you might think I'm crazy. Warren Buffett has said something similar for decades. He famously reminds us, price is what you pay, value is what you get. Yet most investors do the opposite. They obsess over daily price movements, stare at charts, and chase social media trends. Instead of asking, what is this business really worth? They focus on, where is the price going tomorrow? In this video, I'll explain how Buffett thinks about intrinsic value, why it matters more than market price, and how to estimate it. This single idea helped him build one of the greatest fortunes in history. Welcome to Mardic Finance, where we break down investing concepts in plain English for everyone, even if you're just starting. First, a quick disclaimer. This is for educational purposes only, and not financial advice. Always do your own research. Warren Buffett is the longtime chairman of Berkshire Hathaway, the massive investment empire he turned into a powerhouse over 60 years. He didn't beat the market by day trading, timing the market, or following hot tips. He did it by carefully valuing businesses and buying them only when they were available at a significant discount to their true worth. One of Buffett's most important beliefs: if you want to own the entire company, you shouldn't buy its stock either. When you purchase shares, you're not just buying a ticker symbol, you're becoming a part owner of a real business. Unfortunately, the stock market often behaves more like a casino than a place of business. Prices swing wildly based on fear, greed, headlines, and short-term emotions. That's where Buffett's famous metaphor of Mr. Market comes in. Imagine Mr. Market as an emotional business partner who knocks on your door every single day. Sometimes he's wildly optimistic and offers to buy your share at crazy high prices, driven by euphoria. Other times he's depressed and desperate to sell at bargain basement levels because of panic or bad news. The key lesson from Buffett is that you don't have to do business with Mr. Market every day. You can simply ignore him when his offers don't make sense and only act when the price is attractive. As Buffett often says, be fearful when others are greedy, and greedy when others are fearful. This brings us to the central concept: intrinsic value. In Buffett's own words, intrinsic value is the discounted value of all the cash that can be taken out of a business during its remaining life. In plain English, it's what the company is truly worth today based on the cash it is expected to generate for its owners in the future. Buffett emphasizes that intrinsic value is not a precise number you can calculate to the penny. It is an estimate, arranged based on reasonable, conservative assumptions about the company's future. If you could predict every single cash flow perfectly until Judgment Day and discount them at the right rate, you would know the exact intrinsic value. In the real world, we make educated guesses. To make this clearer, Buffett often compares stocks to bonds. With a bond, the future cash payments are clearly printed on the certificate. You know exactly how much interest you'll receive and when you'll get your principal back. Stocks don't come with that guarantee. The cash flows aren't printed anywhere. It's your job as an investor to estimate them as best as you can. That process is called discounted cash flow analysis, or Let's walk through a simple, beginner-friendly example using a fictional company called Riverside Manufacturing, a stable, boring but wonderful business that makes industrial tools. This is exactly the kind of predictable company Buffett loves. Step 1. Estimate current free cash flow. Buffett focuses on owner earnings, the actual cash the business produces after maintaining operations. Let's say Riverside currently generates $150 million in free cash flow per year. Step 2. Make conservative growth assumptions. Buffett is extremely cautious and avoids hockey stick projections. For this mature company, we assume cash flow grows at a modest 4% per year for the next 10 years. Step 3. Project the cash flows for 10 years, starting at $150 million and growing at 4%. Year 1 approximately equals $156 million. Up to year 10 approximately equals $230 million. Step 4. Choose a discount rate. This is the annual return you demand for tying up your money today. In the current 2026 environment, with a 10-year treasury yield around 4.25%, a conservative 9% discount rate gives us a reasonable hurdle. Step 5. Discount each year's cash flow to present value. Future money is worth less today due to time and risk. After discounting, the 10-year cash flows are worth roughly $1.35 billion in today's dollars. Step 6. Calculate the terminal value. The business doesn't vanish after 10 years. We assume it grows at a modest 2% perpetually after year 10. Using the Gordon growth model, the terminal value at year 10 is about $3.1 billion. Discounted back to today at 9%, that equals roughly $1.31 billion. Step 7. Add it all up. $1.35 billion explicit period, $1.31 billion terminal equals total estimated intrinsic value of approximately $2.66 billion. Now compare this intrinsic value to the company's current market capitalization. If Riverside trades at a $1.9 billion market cap, it may be trading at a nice discount, a potential Buffett-style opportunity, provided our assumptions hold reasonably well. However, Buffett never buys right at intrinsic value. He always demands a margin of safety, typically 25% to 40% below his calculated value. This cushion protects him when estimates turn out slightly wrong or when unexpected challenges hit the business. In today's hype-driven market, where many stocks trade on future dreams rather than real cash flow, having a strong margin of safety is more important than ever. It gives you room to be wrong and still come out ahead. Common mistakes to avoid include using overly optimistic growth rates that assume endless high growth, choosing too low a discount rate, which makes almost any stock look cheap, or ignoring competitive threats and industry changes that could shrink future cash flows. Buffett succeeds by staying inside his circle of competence, only investing in businesses he deeply understands with strong, durable economic moats. The beauty of this approach is its simplicity. You don't need advanced math or Wall Street tools. You just need to estimate cash flows conservatively, pick a sensible discount rate, practice on a few companies you know well, and have the patience and discipline to buy only when there's a clear margin of safety. Price is what you pay. Value is what you get. Once you truly internalize this idea, the daily noise and volatility of the stock market lose their power over you. You start thinking and acting like a business owner rather than a speculator. If you enjoyed this clear explanation of intrinsic value and how to apply discounted cash flow the Buffett way, please give the video a thumbs up, subscribe to the channel, and hit the notification bell. Drop a comment below. What company would you like me to walk through a simple valuation on in a future video? Or which part of intrinsic value still feels confusing to you? I read every single comment. Thanks so much for watching. Invest with patience. Think like an owner. And always look for real value. Start small. Stay consistent. Keep learning. And let time and compounding work in your favor. Remember Buffett's wisdom. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I'll see you in the next one. Take care and happy investing.